long call iron butterfly, or better known as a diamond call butterfly. And we call it that because, well, if you laid it out in a diagram, it's 4 options and they form the same shape as a diamond on a playing card. Anyway, this is a trade where you buy 1 call, sell 2 calls further out, and then buy an additional call further out than that. It's an equally weighted spread. You have an equal number of long versus short options. You use this when you expect the market to make a move up, but not go on to be beyond a specific point. And one of the reasons to employ this type of strategy is to lower the risk of the main call option, the primary moneymaker. The profit potential is limited to the difference between the long call and the short call, less the cost of the spread. Maximum profit is achieved at expiration if the market is trading at the short call strike prices. The risk being long the outside options and short the inside, the risk is limited because you have caps. To keep the risk limited to what you paid for your spread, the long calls need to be the same distance from the short calls. What we're looking at here is the Dow Jones Industrial Average. Now, we're under the assumption that we feel the market can go back to the top of its range, which is right about here. However, all of our technical indicators are showing us that the market could sell off further. And buying just a 104 call by itself runs about $1,684. Now, we look at the market, in terms of, well, what if it continues to go down, or what if it goes sideways instead of up? Because it can do one of 3 things: go up, down, or sideways. In a down market or a sideways market, the 104 call will not make money. So we always want to reduce our costs and reduce our risk as much as possible, and being realistic. Now, yes, being long an option gives you unlimited profit potential, but a market spends 80% of its time trading in a range and only 20% of its time changing that range. So most likely the market will maintain its current range into option expiration, which is the purple line. How do we calculate that? Well, this is how we do that. Bottom of the range, top of the range. So what we're looking at is we feel that the market will be somewhere in this area in the next 60 days. Okay, now, so we get filled on the trade. Now, instead of spending $1,684 for the 104 call, we get filled and we pay only, look at that down day, and it comes back up. And we only pay out of pocket $270 plus commission. Now, on a trade like this, there are 4 commissions. Now, based on the premium paid, we have a break even. Instead of the original break even to the 104, which was almost at 106, our break even now on the 104 on the 104 side is 104.27. In fact, this trade will make money anywhere from here 107.73 all the way anywhere between there and 104.27. I know it says 28, pretend it says 27. So in other words, this is what the beauty of this type of trade. This is your profit playground. And if you notice, your profit playground pretty much encompasses over 80% of where we expect the market to be come option expiration, which is over here. Now, if we're wrong and the market goes way up or way down, our risk is limited to the $270. Okay, so we got filled. We've got $270 at risk. Let's see how we do. 28 days later, the market goes up. Now, this type of trade is a little tough to get out of in the early stages because you need the option, you need the market to be near expiration to get the full intrinsic value out of the trade. Right now, the extrinsic gain of the 106 calls are offsetting, because you're short 2 of those, is offsetting the intrinsic gain by made by the 104 call. So you have to wait till it gets closer to expiration. 28 days later, the market comes down, and then going into expiration, oh, imagine that. We were exactly right where it would go out, expire worthless, where the options would expire, rather. And going into expiration, well, you've got a gross return of $1,410. This type of trade is a very good trade for taking advantage of range-bound markets.